Hi, I'm Darcy Crow, Senior Investment Advisor and Portfolio Manager at Crow Private Wealth. Thank you for joining us for our first Alternative Spotlight series of 2022. Our Spotlight series focuses on providing exclusive access to top managers across Canada in various alternative asset classes. So, alternative assets have been a focus of ours for over a decade now. We are seeing the recent market volatility, heightened equity valuations, and the low interest rate environment that we're in really increase the interest we're seeing in these alternative assets. We're getting a lot of inbound calls looking for specific alternative asset expertise, so that's a good sign that this is on people's radar. So, real estate is an asset class we've held in client portfolios for many years, and we continue to view it very favorably in our current market environment. So, with that, I'm thrilled to welcome Corrado Russo today, who serves as managing partner and head of global securities for Hazelview Investments. Corrado has over 20 years of experience in the investment field. He was formerly a portfolio manager of global real estate securities with Forum Securities and for City Property, and an assistant portfolio manager of direct real estate for Ontario Teachers Pension Plan. So, Corrado, thank you so much for taking the time to speak with us today.
Thanks, Darcy. Happy to be here.
Fantastic. Well, to get going on a discussion, if we can just start today with you giving us maybe a general overview of Hazelview Quadrant Fund for those that might not be familiar with it.
Sure, happy to. So I think if we start just with Hazelview in general, and I think it'll sort of help explain the fund itself. Hazelview is a 20 plus year asset manager. All we focus on is real estate. You'll actually see in a moment here, we put up our first slide that we've become a global real estate manager around the world. So we, over the last 20 plus years, have grown to about 10.6 billion of assets under management, and again, focused 100% solely on real estate. And to do that, we've expanded in a couple different ways. One is obviously global, having offices in Toronto, New York, Hamburg, Germany, as well as Hong Kong, to look for opportunities around the world for our investor base. But we've also expanded across the different facets of real estate, and I think that'll sort of blend nicely into the discussion on the Four Quadrant Fund today. We invest not only in direct assets, so bricks and mortar, which is typically what we think about when we think about buying a piece of real estate, leasing it out to tenant and collecting that cash flow stream, but we also lend capital to other operators of real estate, and we also buy publicly traded high quality real estate companies around the world. And why we do all the different facets is, at any point in time, depending on the market, depending on the cycle, depending on the sector, you may have inefficiencies in pricing. So you always want to access that alternative or that real estate in the best possible price so that you can get higher risk adjusted returns, which is ultimately what our goal is. You can see how that blends into on the next slide here, the actual strategy itself, the Four Quadrant. And so why it's called the Four Quadrant is because of what I just talked about. We brought together all of the core competencies of Hazelview into one product. You've got private equity, which is buying the bricks and mortar directly, private debt, lending to other owners of real estate, public equity, buying publicly traded companies, and then buying other companies that are publicly traded that are in the business of lending capital to real estate. So you bring all of those four together. And why we think that's important is, one, if you look at the decision to add real estate to a fixed income and equity portfolio, there are diversification benefits that real estate brings to the table, which we can talk more about if you like as well. But our view is, if you made a decision to add real estate, then you should take advantage of all the different aspects of real estate, like the big pension funds do, like the big institutions do, that have the ability to put capital across these four quadrants to further add to that diversification benefit and that ability to maximize risk-adjusted returns.
Yeah, no, that's fantastic, and something that we certainly really like about the Four Quadrant Fund is it puts into the expert's hand to and the flexibility to be able to take advantage of where those opportunities exist in any given time of the market within those different opportunities. So thanks for giving us that overview. You mentioned briefly there diversification and the importance and benefits of diversification outside of just your traditional stocks and bonds is something we speak to a lot with clients. So, based on the market environment that we're in today, inflation and the hunt for yield, to hot topics that come to mind. How do you see allocations to real estate and in particularly the Four Quadrant Fund being benefiting overall portfolios?
Yeah, so maybe we can start with the sort of yield and the hunt for yield, and then we can speak to inflation as well. I mean, obviously, this has been the big driver of alternatives, and obviously, real estate being one of the biggest alternatives out there has seen a ton of inflows, and we continue to see a lot of capital coming into the real estate space, and it's for that exact reason, the hunt for yield. You can see on the chart here on the left side what's happened to the bond market. Yields are becoming more and more difficult to find in the fixed income market to meet the needs of your client base in terms of income needs to spend on day-to-day things and on monthly income that's necessary. And so people have turned to alternatives like real estate where you are able to still get a very attractive yield. The four quadrant fund delivers a 5% dividend yield that's fully funded from the underlying investments in terms of income and capital gains that it generates each year. And then if you look at the last slide there, the correlation matrix, on the previous slide, the last graph, my apologies, you'll see the correlation that, real estate, not only does it give you a better income, but it also helps reduce the overall risk of the portfolio. And that's because it behaves differently than equities or fixed income. And so you get that diversification by adding it to your broader portfolio and bringing down the overall risk. You also asked on the next slide about inflation. So inflation is obviously another driver of why people are paying so much attention to real estate today. And here I've just used the example of REITs, and and you can see real estate there on the third bar. Real estate and REITs in general are two of the best places you can be in an inflationary environment. And that's because many of the contracts, the lease contracts that tenants sign, have inflation built into step up in rent. So as inflation goes up, the cost of rent goes up in lockstep or sometimes higher than the pace of inflation. And obviously, if you have shorter duration leases like apartments or hotels, you can instantly build in higher prices to offset inflation. And you can see how the performance of the asset class does versus other alternative asset classes that you have, whether it be energy, equities, copper, fixed income like corporate bonds, telecoms, industrials. It is one of the best places you can be in an inflationary environment. Obviously, as the cost to build new real estate goes up, that makes the existing real estate more valuable. So we've all heard about lumber going up, concrete going up, steel going up, land values going up, and that's making developing new assets more expensive. And so people turn to acquiring existing assets as a better value than building new. And when you see the supply drop, that gives even more pricing power to the existing landlords that have buildings to increase rent at the pace of inflation or higher.
Okay. Fantastic. Yeah. And when you look at the yield opportunity in the market today, finding something that's, a 5% yield, that's not going outside of risk parameters is not an easy task these days. So thanks for speaking to both of those points. Why don't we flip to performance of the strategy just to give investors a bit of an idea of the historical performance of the strategy. So perhaps we can talk to both longer term performance as well as specifically how the strategy has fared over the last couple of years getting through the pandemic.
So over the last, we just actually had our 10-year anniversary in December of last year, and we've averaged a net return to our clients of just under 10%, 9.6%. And I think what's also attractive is just the low risk that we've done that with. Volatility has been 6.3%, which is much lower than the equity markets, which has been 14.5%, and very similar to the fixed income market, which has been around 4%. So you're getting a return that's in line or higher than the Canadian equity market with much lower volatility. And at the same time, with a 5% dividend yield, you're getting higher income than you would in the fixed income market with similar volatilities. And that's really the value proposition of the four quadrant fund. And you can see when you measure it against return divided by risk. So how much return you're getting for each unit of risk you're taking on. The four quadrant fund gives you 1.5 units of return for every unit of risk that you take on versus the equity markets at 0.6, the fixed income at 0.8. And you can from the top part there just how it behaves during market corrections, and we circled a few of them, obviously COVID being one of the biggest ones, and you can see how much less this product dropped during March, and you can see that it's outperformed both of those asset classes, and it does it with a smoother ride. So it's not only about what is the total return at the end of the day, it's about the journey. It's about how much volatility you took on throughout that process while you held the investment.
Yeah, absolutely. And we talk about that law, smoothing out the return stream. And that takes a lot of some of the emotional side that comes out of investing to make sure, people aren't making mistakes along the way and therefore getting, the best return possible with the risk taken on. So that fits very well into speaking to why we incorporate alternatives into portfolios. Why don't we, if you can give us a couple of examples of recent purchases made within the portfolio and perhaps a recent exit or two as well, that would be great, just so people have a good idea of the types of properties or ownership within the fund.
Sure. So you'll see here, there's a few that I put on here. Happy to go through them all in as much detail as you like, but maybe just to start from a high level, industrial, office, residential are three of the areas where we're seeing significant amount of opportunity for different reasons. Industrial, just given the e-commerce trend, as we've all sort of switched to online shopping, that's created a tremendous amount of demand for warehouse space and logistics. And this is space that's very difficult to get your hands on. So we have, over the last 3 to 5 years, built up a portfolio of assets that not only are attracting good quality tenants and good rents and good cash flow today, but also have the ability for development, expansions, add-ons, improvements to existing assets that will make them more in line with what online commerce tenants are looking for today. So that means improving the ceiling heights, it means improving the floor loads, it means improving the turning radius on the parking lot. So there's a lot of heavy lifting that goes into improving these assets, and that's really what Hazelview is about. It's all about value add and how we can do something to the assets that we buy to make them worth more when we're finished with them. So here you've got Winston Churchill, which is an industrial asset in Oakville, as well as Burloak, which is actually just down the street. We actually bought these assets with the idea of changing the zoning for the land so that we can add on new properties, and with that zoning came a significant hike in the value of the land, such that we've gotten offers already since we bought this for 2-3 times what we've paid for it. So we'll look at actually turning those around rather than building them out, because we feel like we've gotten full value for them. But it just shows you the amount of demand there is for new industrial assets for tenants like Amazon that just need the space so that they can deliver the goods to the clients just in time. On the office side, this is really interesting. Office, there's been a tremendous opportunity to buy some misunderstood office. We all can have a debate on work from home, how many people will go back to the office, and certainly when it comes down to downtown high rise, there's still a question mark as to what that looks like at the end of the day, which obviously we're happy to debate. But when you start peeling back the onion and looking at some of the other opportunities within office, for example, life science buildings or R&D labs, technology campuses, they are still in huge demand and doing very, very well. And because of COVID, you'd be able to buy it at very attractive pricing. So Murphy Crossing is actually a 5-building, 2-story complex that we bought in Silicon Valley. It's generating a tremendous amount of cash flow. We're getting 12 to 13% cash on cash every single month that comes into the portfolio from this investment, and very strong tenants. It's got great amenities, outdoor volleyball court, backyard, a barbecue area, and it's drive-to with access parking, and obviously with 2 floors. So you don't have the same concerns that many have talked about with respect to COVID. And this kind of product is becoming in greater demand. IQHQ is all about life sciences. This is specialized laboratory space that has high specs in terms of having clean areas, and the amount of technology and energy and cooling systems that go into it. So because of that specialization, there's a lot less of them around, and you can demand higher rent. And this is a space that as well is becoming in huge demand. So we're seeing some attractive opportunities there as well. And of course, on the residential side, one of the main issues this planet has is a shortage of housing. And the only way to sort of improve the housing crisis and to try to improve the ability and affordability for housing is to create more. And so, we have been creating, new projects, and these are two specific ones. One in Burnaby, which is an area that is starving for new apartment buildings and condominiums. And so we'll be building into that environment. We're quite excited about that. And the Bloor and Dufferin is one that's in Toronto. There's a huge trend towards live, work, play. You want to live, work, and play in the same area, the same environment. And so this is a mixed use project that will have residential, but it'll also have a amount of office and amount of retail in it as well. And we're already starting to see some very strong demand from tenants to come into this space.
Fantastic. Well, that's I think a really good subset, just giving us an example of what you own in the portfolio. So lastly, and you certainly touched on it in giving those examples, but just wanted to get a sense of where you're really seeing opportunities today, and perhaps what you and the investment team are really excited about in the coming 12 to 24 months.
Yeah, it's a really interesting time to be in real estate. There's kind of a two-prong approach here. There's some of the areas like retail, hotel, and office that were significantly hurt by COVID and the lockdown and the inability for people to move around. And what we've seen in places like the US, for example, that have now opened up is a tremendous snapback in retail demand, but not all retail. If you look at non-essential, fashion-oriented malls, for example, they're having a tougher time, especially if you can buy, a lot of the commodity-oriented goods online. But essential retail, like your grocery store, like your services, these types of assets are doing very, very well. And those are the assets that we tend to hold in the fund. Hotels, again, tremendous amount of demand. If anybody's tried to book a vacation recently, they'll know what's been happening to hotel prices. In fact, if you look at the what we call ADR in the hotel industry, average daily room rate, what you'll see is that average room rate is 20 to 30% higher than it was pre-COVID.
Wow.
Pre-COVID, for vacation-oriented leisure travel. Of course, business travel and convention space continues to lag, so you really have to understand which markets you're getting into and what you're getting in front of. Office, again, high-rise downtown, we really won't know how that all settles out until work from home, restrictions and mobility change, and we see what the end result of work from home will be longer term. We're still confident that people are going to want to be in the office in terms of collaboration, the ability to evaluate employees, the ability for employees to get promoted and have face time with their clients and their bosses is going to be tremendously important. And how the office looks for the high-rise downtown will change in terms of adding a lot more amenity. But if you look underneath that, the next layer of specialty life science R&D, there's a tremendous opportunity. Demand is extremely strong, and this is an area where we think we have a lot of potential within the fund. Industrial, I already spoke to. Again, as we've sort of seen a shift to just-in-time logistic warehouses rather than your old industrial storage facilities. That comes with a big increase in terms of technology and specs that tenants require, and that's an area that we're pretty excited about. And then, like I mentioned, housing is an extremely important sector for consumers and for people looking for affordable housing. And so we obviously want to be part of the solution there, and we think that can obviously reap rewards for our clients as well.
Fantastic. Well, I think that gives us a really good overview of the Hazelview Quadrant portfolio, and I think just how unique it is in terms of the flexibility that's involved in terms of what types of property you're buying, within what industry of real estate, within what securities, given the opportunities. So thank you so much for taking us through that. As I said, we truly believe that real estate's a really important part of client portfolios in the years ahead, bringing down correlations, minimizing volatility while continuing to drive returns and seek some yield within assets. So I do need to take a moment to reiterate these discussions shouldn't be considered a direct recommendation. So if you are interested in learning more about Hazelview or alternative assets in general, please reach out to us at any time and we would be happy to set up a time to discuss. So Corrado, thank you so much for joining us today. We really, really appreciate your insight and taking us through that portfolio. And thank you everyone for watching today. We look forward to keeping you updated on leading portfolio managers within the alternative space in the months ahead as well. So Corrado, thank you so much.
Thank you, Darcy.
Okay, enjoy.
Bye-bye now.
Bye-bye.